Welcome everybody to the Middle Class Investor for this week. December 21st is the day. We had another volatile week in the market, and both up and down. And the volatility is definitely signaling, could be signaling a potential trend change. And certainly it's signaling that there's a larger tug back and forth in the market around what is value. And whether it's global events or it's the banks or it's the Fed or whatever, at the end of the day it doesn't really matter. What matters is when the market goes down you lose money, and when the market goes up you make money. So all we're trying to do is focus on what the market is doing and what it might be doing, for the next couple of months, next 3 months, next year, things like that. So a lot of people look at earnings, they look at earnings expansion, they look at the health of companies and things like that, some of these fundamental things that are there in the marketplace. What we're looking at is basically just the price. The price tells us what we need to know about what's going on in the market. And because all those other people are looking at all those things, we don't necessarily need to be looking at those things. We just need to look at what they're doing. So what I've got on the screen right here is the 10-year Treasury interest rate. And this is probably the single most important interest rate in the global marketplace. There's a couple other important ones like LIBOR and the Fed funds rate, but for most consumers, the 10-year Treasury is the most important interest rate. It's also known as the risk-free rate. It's known by a couple of different things. Generally speaking, the interest rate needs to be GDP plus inflation. If it's not, then you get an inverted situation, and that's not good. That causes all kinds of problems in the market. The reason the 10 years been down is because people generally believe that interest rates are low, and of course GDP has been fairly low. So if the interest rate 10-year Treasury starts to go up, that means that the expectation for GDP is going up, or that means the expectation for interest rates going up, or it could just mean that we're having some flight to quality that's being caused because of fear in the marketplace. But the longer term trend is GDP plus inflation is what drives the 10-year Treasury. And when I mean longer term trend, I mean this is a 30-year cycle kind of trend. So generally speaking, we're at the bottom of that 30-year cycle, and it's been going on for about 34 years. So what we've been focused on right here is that this potentially is the low back here on the week of July 23rd, 2012 at roughly 1.39%. And if this is the low and this move up is the first move off the low and this correction back is the first correction off the first move, then what we're looking at is a pretty solid breakout to the upside that could take us to 4 or 5% interest rates in pretty short order. So that's the reason this is important is because if you have bond funds and things of that nature, which a lot of people do, there's been a lot of money flooded into high yield, which incidentally they're losing a lot of money right now in high yield. High yield is we can look at J and K in a minute. And, high yield has been suffering quite a bit, and it will suffer even more if this market bumps up to the upside here. So what we've been focused on primarily is these two lines here, this downsloping line, and then I've got kind of a place where it looked like it bottomed, and then I kind of made an upsloping trend line. So the first thing we're going to do is look for this line, a breakout of this line right here. And if we get a breakout of this line, it's a pretty good chance that this downtrend is over. And certainly, if we get a breakout of this line and this line, I think we can say that this pullback is probably over. But as long as it stays below this area This zone right here is still in play, and so I think we need to, just wait and see here. Certainly it could pull back and make a lower low. If it makes a significantly lower low, like down in this area, let me draw that for you. If it makes a low, let's say below this area, then it's likely coming all the way down to this box right here. And now keep in mind that the low that we looked at earlier back in July of 2012 was 1.39. So this area right here is 1.5. So it wouldn't be a new low, but it could be an 70-80% retracement of the previous uptrend, which is certainly possible in the market. Things like that happen all the time. So that's the 10-year Treasury. I said we would look at J and K, so let's do that real quick. J and K stands for junk bonds. It's the high yield. If I can get that to come up, there we go. So let's look at a 9-month. You can see that you get this kind of curving topping pattern here, and then here recently it's had a pretty big sell-off. And a lot of people look at they put this chart over the 10-year Treasury, and they look at the spread between the 10-year interest rate and what junk yields. Now this isn't a yield chart. This is just a high yield ETF. But if you could track the junk bond yields and you compare them to the U.S. Treasury 10-year yields, when those spreads get really wide, which they are widening as we speak, usually there's some sort of miscalculation of risk, and we usually come back together, and that moving apart and coming back together causes other changes in other markets, and that's what we're focused on, is the results of those types of changes. Now the one market, let's look at the euro US dollar. This market is really important, and you can see here that the euro has broken below that line we were focused on. So we were looking at this line here, thinking that, well, I was thinking anyway, I don't know what you guys are thinking out there, but I was thinking that this line would probably hold. It of course has not held, and so what you've got here is you got the potential for coming back into this support area that we marked here a while back. Now this support area will be a new recent low. The previous low was right here at 1.205. If it makes it to the support area, the support area starts right here around 1.2. So we're talking about making a new low. It appears that that's what it wants to do here. Now, I mean, we could get, next week we could get, something that looks like, we've talked about this before, like a bullish harami. A bullish harami is when you get, kind of a square inside a full week's candle. Now this would be after the whole week, right? So we wouldn't know this until next week, and then the following week after that, if we got a close above this high right here, then that would be a bullish harami, and we would say it looks like maybe the market's starting to trend back upward. Okay, and then a logical place for it to go to first would be right here at this area, this previous support area. So anytime you break support then becomes resistance, and so you would look for the market to trade back up in this direction right here into resistance, and then come down and make a lower low, or come down and make a higher low and continue upward. So once you get some sort of trend change, I mean, it's not difficult, right? It either goes up or down. I know that's obvious, but what you look for is it to go to resistance, and it'll either kind of jog a little bit here, maybe like this, and then go through the resistance, or you could see it jog a little bit and then break down and make a lower low. So those are the two scenarios that we'll be looking for. There's no way to know what's going to happen here, but I think it's safe to say that the euro is in a larger downtrend. I mean, if you look at let's go back and look at well, technically it's in a consolidation, but if you go back and look even further back, let's look at, well, euro hadn't been around 20 years, but I pulled up a 20-year chart. Certainly since June of 2008, the euro has been in a downtrend, albeit choppy. So we would expect that to continue. Once you break out of this lower line here, let me show you which line, then we could say that the euro is likely to begin changing trends. So the line I was just looking at is this, let me pull it up here. So where would we expect the euro to potentially change trend? Not until you got above this area right here, this blue line, which I can't draw on top of for some reason. So we're going to expect to happen is just to see the euro come up here and hit resistance and then go a little bit, go lower. In fact, we've been talking about maybe the euro and the dollar reaching parity, which means 1 euro equals $1. So it's not unusual for that to happen. The dollar's strengthening quite a bit. The euro's weakening. We'll look at the dollar in a minute, but that seems to be what the market's wanting to happen. Now, switching to volatility. Volatility has been crazy. It's even crazier for short-term traders to manage. It's good and it's bad depending on how you trade. But you can see this trend line that we drew a while back. It's kind of holding, so we might expect volatility to come down a little further, meaning the market might go a little higher from here, and then maybe have volatility turn back up and head back into this low 30, high 20s, low 30 area, and then just continue to go, kind of migrate its way higher. At some point, the volatility is going to resolve itself. If it continues to go higher, the market will resolve itself lower, and so that's the risk we're trying to protect ourselves against, and that's what we got our eyes open for. Now, switching to the S&P 500, we still got this similar pattern here. The interesting thing is, I mean, we're just running out of room, and I suppose we could just run this pattern until it can run no more. But the reality is, you run up into this narrow area, it really kind of defeats the purpose of the pattern. So I don't think there's much left in this pattern. We've already had it trade out of this pattern right here, and then get right back in it. And then we had it trade out here, albeit very lightly, and then more here, and then it jumped right back in. So I don't know, this pattern, I'm probably 2 weeks from removing this altogether. Sometimes these patterns don't work out, and the reality is this one's very, very large, the largest one I've ever seen. So it may just be that it's not really important, given the fact that it's so large. I don't know, but I think this support area is still important. This upper line is clearly important. I mean, you can see the difficulty the market has in getting over this line once it reaches it. So I think that the upper line is still important, and it's just I'm not so sure the pattern itself is important. So and you can see we sold off, and last week we had this right here, right? And I think I said at the time, because we finished at the lows, which you can see here, there's no wick. This is a wick right here, this little line underneath the candle. And see, there's no wick here. And I think I said, because we finished at the lows of the week, that we might get a little bit more selling. Of course, we did. We opened right here. We sold off. So I've done this before, but let me just do it real quickly again. The way this works is, if it's a down candle, the open is here. Okay, so this is open. Well, that's open, and then close is right here on a down candle. On a white candle, this is the open, and this is the close. Okay, so what happened is, here's the close. So we closed the week at the lows, and then we opened pretty close to where we closed. But the first thing the market did is it went down. Okay, it went down to this low here. That's the first thing it did. It went down to this low, and then the bulls drove it back up all the way up past where it closed up here, and then the bears drove it back down to here to close it. Okay, and that's the way you read these candle patterns. The Dow, pretty much looks the same, although this line here, we've talked about it before, but this line is connecting the 2000 and the 2007 highs, and you can see we've been all around it. We've up, down, below it, back above it, below it, back above it, and we're currently above it, as you can see here. And you can see that 18,000 is just around the corner. The markets like these round numbers. It's certainly possible that the market could get up to 18,000 just because it wants to. So that's kind of looming out there. The other thing I would note about the Dow is that the range for last week finished inside of the range of the previous week. So again, just like we have bearish haramis, there's also bullish haramis. So because this is inside, see, this is inside the body of the black candle from the previous week. If we were to get let's say a candle next week that closed below, so this would be the close, it would be a black candle, and it would, let's say it closed below this low here, then this could be a potential trend reversal, and we would look for the market to continue, making little boxes like this downward. Okay, so we'll keep an eye out for that. It's not an official trend reversal until the boxes start going back up, right, and make a lower high, right? We've talked about this before. Here's a high. Okay, here's a low. Whoops. Oh well. You know what I was going to do. I mean, I've done it several times. So we look for the market to make a new low, come up, make a lower high, and then roll over and make a new low again. So we're looking for the stair-step pattern. That's basically what we're looking for. So you can see here we have a stair-step pattern up, right? And as long as that's intact, the trend is up. And by the way, the trend is up. It hasn't changed. We had a slightly lower low here below this low, but then we came back up and made a new high. So that's not a trend change. It's a potential trend change right here, but this new high negated that. So the only way that would have been trend change is if it came up and made a high, let's say right here at the line, and then rolled over. And then we could say that was a trend change. Let's look at the European markets real quick. This is Germany. We've got this line here on Germany. Seems to be holding up really well. Be interesting to see in the next couple weeks whether it breaks down through this line or if it bounces and goes up and makes a higher high. Japan's kind of in a sideways pattern. In fact, let's just draw that on there right now. We've got kind of a sideways consolidation in Japan. We'll look for it to resolve itself either going up or coming and breaking down through this box. The United Kingdom looks like it pulled back really nicely here to this support area, which was off of this low, and I would say it's at a critical place. The area that I would look for the UK to go to, let me get it on this screen here. The resistance area is off of this high here, so I would look for this particular market to travel back up into this area. So what I mean is we're looking for it to come up here, make a slightly higher high above here, and then either wiggle, and go higher through this, okay, or wiggle and go lower. And I know that's crazy it's either going to go up or below it. But that's just the nature of the market. There's nothing I can do about that. There's nothing that anybody can do about that. You don't know whether it's going to go through this area or whether it's going to use this area as resistance and come back. You know initially it'll be resistance, but you don't know longer term whether it'll be resistance or if this market will break through this resistance. I think it's certainly possible that the market could wiggle here, break through resistance, and then have this be resistance. Okay, this lower trend line here that we've got marked. I think that's possible. Or it could come up, make a little wiggle, and then go lower from here. We just don't know. You just have to kind of play it like it goes. But if you can get used to seeing the market this way, you can plan a little bit better and potentially, make better investment choices. Because if you're investing in stocks in the FTSE, okay, and the FTSE is making lower highs and lower lows like it is currently, okay, then it tells you something about what the stocks are likely doing in the FTSE. So that's why this is important. Same thing with the S&P 500. If the S&P 500 is making higher highs and higher lows, then you can be generally long in S&P 500 stocks. If it's making lower highs and lower lows, then you want to be generally short or on the sidelines. What have we not looked at? Let's switch over and look at the dollar. Here's the dollar on the screen. You can see the high was back here in when was this? June of 01. And we had a pretty big sell-off here and then consolidation. But you can see now that the dollar, and we've talked about the dollar taking out these two highs here, and we drew this resistance area on the chart here at around 95, and you can see the dollar is still making its way up to this area. And the same type of decision will be necessary here. Does it hit this, come down and wiggle and go lower, or does it hit this, come down and wiggle and then go through this? No way to know, just got to watch it. But depending on what it does do, that'll tell us a little bit about where we need to have our money. Okay, here's gold. Let me zoom in on a little bit. Gold, as you might expect, had a low way back here. Whoops, that's not even on the chart. Let me scoot it over a little bit. Had a low way back when in, when is this? August of 2000, August of 99. Okay, this is a good example of if this is the bottom, which it was. Okay, and we had this initial move off the bottom, and then we had a correction. Okay, so this is a correction off an initial low. So we had initial low, move up, a correction. See how big this next move is? See how this next move was really large until it, I mean, it really didn't even sell off until you got to May of 06. This is what I'm talking about in the bond market. So when I look at that low and then I look at that correction into the low and then I'm talking to you guys about how big this next move could be, this is the type of move you could get. So gold initially hit a low of 253. It pulled back to essentially 254, 255, and then it proceeded to go to 1,923 over the next 11 years. And trust me, you don't want to be long bonds if you're going to have that kind of move in the bond market. Okay, so that's why I'm focused heavily on that bond market move, because most of you, if you're in your 401k or IRA, you're in a bond fund, and bond funds, because of their perpetual in nature, you can't just buy. If you bought a bond, let's say you bought a $100 bond and it's a 10-year bond, that means no matter what happens in 10 years, it's going to be worth $100. But in a bond fund, that's not the case. In a bond fund, it's a perpetual type of calculation, because the bond fund is made up of all kinds of different bonds. So the only way that they can adjust the value of the bond fund is adjust the overall value of the fund. And the way they do that is they look at the yield, and they look at the total value of the bonds in the fund. And in general, if you have a rising interest rate market and you own bond funds, you're losing money. So we don't want you to do that. So we're keeping a close eye on that here at the Middle Class Investor. But you can see here, gold peaked in 2011, August 2011. We've been correcting. So we had kind of this up, down, down big, and then this consolidation. And I really thought gold would get back into this 1100 area before it took off. It looks like it kind of took off early. We got this little, here's a low, here's a high, here's a lower high, here's a higher high. So it's kind of stair-stepping up. This is starting to look like the low. And certainly if we got above, if this particular market got above this line right here, this downtrending line, if it got above here, then I think you could say that gold is through going down for the time being. But I think it's likely that before that happens, you're going to see gold. It's going to hit its head on this. It's going to wiggle. Okay, that's the nature of it. And then it's either going to go up through this and through that line, or it's going to come down and make a lower low. That's kind of how the markets move. So we're going to keep an eye on that. We're going to see what happens. But that's gold. And that's about it for the Middle Class Investor this week. We've looked at everything. I hope you guys have a Merry Christmas. The celebration of Christmas is special to all of us, whether you believe in Christ or not. Christ is always there for whoever wants to believe in Him, and that's where our salvation comes from. So I hope all of you have lots of enjoyable time with your family, and I hope you remember why we celebrate this time of the year. It's certainly important to me and my family, and I just really I'm thankful for you guys coming in, the ones that come in each week and watch the Middle Class Investor, and I'm hoping that by doing this, I can keep people out of trouble, out of losing their life savings. Some people, especially if you're in your 60s or somewhere in there, you really can't afford to take any more of these big moves like we've had. And I'm just hopeful that it helps some of you out there, your family members, people like that. So Merry Christmas, and we'll be back. We've got shortened weeks. The markets are going to be open for, I think, 3 days next week, and then it'll be the same way the next week, 3 days the following week because of New Year's. So I'll be back in. We'll make a video. We'll try to make it short. I can't imagine that too much is going to happen in either one of those weeks. So we'll make it pretty short and painless. Okay? Thank you, everybody. Have a Merry Christmas. We'll see you next time. Bye-bye.